We'll call this meeting to order, the Financial Management Board of May 8th, 2024. We will do a roll call. Sam Ashbaugh here. Marty Basic here. Adam Bauman, not here yet. Harry Johnson here. Tom Provins here. Andrew Renkley, yes, here. Kevin Repchek here. Jason Ruggles here. Elaine Vincent here. Staff members Andrew McCreary and Terry Winstein and Commissioner Steve Silverman are here. Steve. Seeing nobody in the room and only Sandy online. I don't think there's any citizens' comments tonight. We do not have a chairperson yet, so we'll come back to that at some point when we elect the chairperson, hopefully in item 7. But we'll go move to item 4, a pension quarterly update. So just want to give a little background as to where we're at today for this Financial Management Board meeting. There used to be a pension investment advisory board prior to the board consolidation. It was in existence since the early 2000s. It originally started as a monitoring and consultation with PFM Asset Management, which Perry is a representative of. This is Perry Giovanelli. He'll be introducing himself here in just a second. And we had a long-term relationship with them from the early 2000s to 2015 in a consulting type relationship, which means that all the investments were Mount Lebanon's, and we were the ones that contracted individually with the investments. It was a lot of work and not timely. And Act 44 of 2008 also made it very hard to change investments because you had to RFP every investment, and it took upwards of 6 months to change your investment in some cases. That was also due to the fact that we met quarterly. So they would run the RFP, we'd meet quarterly. So it could take upwards of 145 days-ish. There was one that we ran the analysis on, was up to 145 days. Why I say that is that in 2015, we went out for RFP for a discretionary management model. What that means, for those that may not know, is that we have a fiduciary now with PFM to where they have full discretion with our plans within our investment policy statement to make investment decisions on our pension plan's behalf. So we no longer do the consulting relationship to where we own the investments and all those things. PFM and their firm move the money and take care of all that. There are some that we may get into investments that we are the owners of that are within the plans. But ultimately, PFM is an additional fiduciary on our account. And they won the business. We had 9 respondents in 2015. We interviewed 3 of them that got to the final, and we ultimately decided to stick with PFM in their discretionary management model. I shouldn't say stick with, they won, flat out won. We like their model, and you'll see in today's report why. I think PFM has been a great partner for over 20 years, and we like to make sure that our pension investment board and now the financial management board is apprised of what's happening within our 3 pension plans and our OPEB trust fund. OPEB stands for other post-employment benefits. These are healthcare and a small life insurance benefit that is available to contractual and non-uniform employees. So that's also within their discretionary management model as well. So they manage 4 of our plans: fire, police, general employees, and an OPEB plan. Okay, so I'll let Perry take off and start with our quarterly update for our pension plans.
Hello, everyone. So just to introduce myself, I'm Perry Giovanelli. I live here in the Western Pennsylvania area. I actually grew up in Kensington, and like most Western Pennsylvania boys, I didn't get too far away from mom and dad. I still live out in that direction. So they got to be grandparents for a long time, so that was enjoyable. But with that, I have been in the investment business now for well over 20 years. Prior to that, I spent about 10 years in more of a business consulting role. So with PFM, we have, and I've been with PFM now for about 8 years. Joined the firm in 2015, pretty much right around when you guys are making the transition. From that standpoint, I want to say there. Let's talk a little bit more about PFM from that standpoint. In our discretionary asset management, we do about $27 billion across the country. Predominantly in the public space. PFM actually stands for Public Financial Management. As a whole firm, we did a tremendous amount of work also around what is called FA work or financial advisory work, but it's not this type of investment advisory work. It's more when public entities go out to issue a bond to do major projects. We have advisors that independently do that type of advisory work. Why do you need that in that arena? I won't go too long into it basically, but it basically gives you an independent person to help you work with the banks. So when you're issuing bonds and you're making those long-term projects, we do that type of stuff. Our firm also does a tremendous amount of managing those short-term assets. Often you get, you know, a $3 or $5 million bond to build a bridge, whatever it is. We manage those assets to that construction project, you know, from a short-term cash standpoint. Across the country, we do about $170 billion in that arena. So we do a tremendous amount of short-term cash. So with that being said, we've been around since 1974. Back in 2021, we were acquired by US Bank. So we're now, you know, a subsidiary of US Bank. It really didn't change much for us as far as it's still our same leadership team is running our firm. It's basically they report to someone now. Prior to that, they were partners, but basically that's what it's pretty much been. What it has done for us over the last 2 years is just given us a broader breadth, obviously being involved with the bank. A little more on the technology and security, cybersecurity side of it is what some of the things we were looking for as a firm, because the size of the firm we were 600 employees. And the biggest issue is protecting your clients, and cybersecurity has been something I'm sure that we all have experienced at some level or another. It's vitally important. So that was an advantage to us. We actually had about a 25-year working relationship with US Bank. They custody probably about 80% of our clients. So that's how, so we had really, it was kind of a very smooth, I've been through a couple takeovers through my career, and this was kind of a rather smooth acquisition, pretty smooth. So that's why I'm still here.
There's the interrupt. They're our custodian as well.
Yes, yeah. So US Bank's been a custodian for quite some time. So let's just give you a little bit of background about, you know, PFM and what we do. The side of the firm that I had mentioned about the financial advisory work, that actually stayed independent because they can't be owned for a bank and do what they do, because they need to be independent from that. So that side of the firm did stay independent, but we still have what I call like a sister relationship with them. So we still interact on a lot of what we did before. A lot of times when they're working with something on a client and they need someone to come in and look at short-term cash or something longer like that, we have that same relationship, and vice versa. One of our clients talk to us about some bond issue coming out or something they need to do on a big project. We bring in that side of PFM. So that's basically the process. So what I'll do is open you up into page 1.1 and just kind of walk through the markets a little bit for you. You know, the first quarter of the calendar year was a strong quarter overall in the equity markets. So up here on this page, we actually utilize the second index down in domestic equity as part of your benchmark as we compare how we do. And that's the Russell 3000 index. So you can see for the quarter, it was 10.02 for a return. For the 1 year number, 29.29. So very good rebound coming off of what 2022 had given us, which was, you know, major negative numbers in that same direction. So with that international equity, very similar as far as solid numbers for the quarter, not as strong as domestic equity, but strong numbers. We utilized the third index down, that's the Morgan Stanley All Country World ex-US in your benchmark as part of the, you know, what we compare to how we're performing on a relative basis. The quarter to date, they came in at 4.69, and you can see their 1 year was at 13.26. So like I said, good, solid, positive numbers, but, you know, half of really what the US has produced, you know, over the past 12 months. And then with that, we utilize in the fixed income arena, the Bloomberg Ag, which is the first benchmark there you're looking at, but just give you the benchmark performance for the quarter. It was slightly negative in the first quarter. That came off of most of the Fed noise, and I'll talk about that a little bit more going forward. Fixed income has been, you know, as volatile as equities really over the past 3 years, you know, which typically everyone looks to fixed income to be where they don't lose money, and it's not as, you know, active as far as being, you know, up and down through the ringer. But really, with everything the Fed has done over the last 3 years coming out of the pandemic, it's been brutal. Fixed income managers are definitely earning their money from the standpoint of trying to stay above water. So with that, just flipping into the economic side of it. I have the one bad book out of this, but the way that my book printed, so you're gonna see me keep flipping around like this, just, live with it, but I figured I didn't want to do that to anybody else in the room, so I kept the bad one. But anyway, from an economic standpoint, and this is the interesting part, right? If we go back a couple years here, the Fed, to address inflation, which hit a high of 9%, they started increasing the Fed rate, right? Trying to slow the economy down a little bit and see, where we could get. So interestingly enough, all you heard for a year and a half was we're gonna have a recession. It's gonna be what will be, a mild recession with a soft landing. Those are all the phrases that we're throwing around out there. We still haven't quite seen it. The economy has really held up rather strong, overall. And so, for instance, the GDP in the third quarter was 4.9% from that standpoint. To give you a feel, if we're over 2, we're in good shape because we're a very large economy, right? So if we produce at least 2%, we've had what I would call a good year, So as you start to get above that, you're in good shape. When we come out of down markets like 2022, and when the economy really does actually go into a recessionary timeframe, GDP as it usually comes out, we'll see it, hit 6%, maybe even a little higher. But typically it kind of comes back to that where we're going to see it somewhere between 2 and 4 over the long haul. And that's kind of, like I said, those are actually good numbers. So with that, the third quarter came in 4.9. The fourth quarter dropped down a little bit to 3.4. But overall, that's very solid GDP numbers. And for the 2023 as a calendar year, when they wrap up all the numbers and get tight, it's going to be a little over 3%. So things have gone very well from an economic standpoint, which has kind of surprised, I think, the markets in general. It almost looks and says, okay, why did 2022 get so drastically negative? Almost like an overreaction to what they thought they saw coming. And 2023 has kind of settled that down. Where we did see so much pressure on inflation, two things. Both administrations printed a lot of money because of the pandemic, right? When you print money, that's economics 101. That's going to make inflation go up. You're just printing paper, basically. But the second piece of it really was the strain on the labor markets. And where that came from is, really the pandemic, kind of what I would describe it as, it kicked off the baby boomers getting out even earlier. We're looking at the next 10 years of being the exodus of labor to be much higher than really what's coming in from a population standpoint. But I think what you saw coming out of the pandemic was a lot of people that were, close to retirement probably said, I'm just done with this. This is too much stress for me. So we had a large exodus out of it. So for a while there, we had labor participation market like below 60%, and that was causing a lot of pressure, right? So what we had was wages going through the roof. And that's the biggest thing to the inflation end of things, right? So, if it costs, a lot more money to get the tomato to the supermarket, it's just going up. Think about everything that has to happen from a labor standpoint to make that happen. And, so all the way along it hit. And if you recall, back in 2020, 2021, you're driving by, entry level, what you think of as like high school jobs, your McDonald's, that type of stuff with signing bonuses, right? And that was because from that industry standpoint, they were looking at saying, how much more can we go hourly? Because the one thing is once you start paying an hourly rate, you don't take it back, right? You don't walk in 2 years later and say, it's a better market, I'm gonna take $2 off it, right? It just doesn't happen, okay? So that's why you saw a lot of signing bonuses on Dairy Queen, McDonald's, a lot of jobs in those areas. So that was all the pressure. With that came that 9% inflation, right? So that has come down considerably. Inflation right now has been between 3 and 3.4, okay? The Fed wants to get back down to 2. And when I say back down to 2, we had a good 20-year run where pretty much you could just write down inflation will be 2%. It's like I'm done, So from that standpoint, they want to get back there. Why have they held up a little bit? It's just interesting. I call it a little bit of the soap opera, right? The market tries to put a lot of pressure, so we're going into January and it's nothing but talk about, oh, the Fed's going to cut rates and they're going to start in March and they're going to make 6 cuts, right? The Fed came out pretty quickly and said, whoa, we're looking at data. We're not real comfortable there yet. Maybe we'll start in June and, we're not talking about 6 cuts, probably 3, not even, so the market's still pushing for 3, right? We get to the end of this quarter, they're still looking at data that they're not comfortable with. We're still seeing inflation around 3.4%. They want to see, if not get to 2, they want to feel like they can see that line going that way, So with that, they kind of came back out again and said, we're not touching this right now. All right. So now everyone's like, the market's still kind of pushing and trying to predict 2. It's most likely going to be 1. and it's most likely gonna come November, December timeframe. It'll be the fourth quarter. I don't think it will come before that. Data would really have to significantly change in the next 4 months for them to do anything earlier. So from that end, so it slows things down a little bit from, like, I guess what I would call, that's what happened to fixed income in the first quarter. Then they get, because they can't see through like what's next, and things start to tighten up, and we still have an inverted yield curve. So that's another issue to discuss a little bit. But with that, that's kind of, those are the pressures. That's what we've looked at from the standpoint of what's making the market kind of interesting from the standpoint of unemployment's 3.8%. If we were going into like recession type of unemployment numbers are usually well above 6. Okay, we went from 3.4 to 3.8. Those are historically low unemployment numbers. The government looks at basically at 5% as being fully employed. They look at that last 5% is usually not matching up to the jobs that are out there. So anytime they can be around 5, they're overall, historically, I should say, we're now down between 3.8 is not a big tick up. So 0.4 of a point. So back to my point about from an economic standpoint, things looking pretty solid. So sliding over to page, I'm gonna have to go with the whole 1.3. So on page 1.3, the other thing I'd like to point out to kind of give you a feel for the economic numbers and why things are actually, pretty solid. This chart in the top right corner, this measures the production of manufacturing and service in the country. Okay. So the yellow line is service, the blue line is manufacturing. The 50 going across, I call it the equator, but basically below 50 is retraction, and then above 50 is growth. All right. So if you look at it, manufacturing did kind of what we expected going through 2022. It dropped down, it had some slowing, rates went up, less things. Housing market is kind of that interesting area that we're seeing, the slowing, and we're waiting to see how that plays out. And let's face it, it's because 2 years ago you could get a mortgage rate below 3, and now you are paying 7. So that's going to slow down that end of it. So there is definitely some manufacturing production that has slowed from that. But you can see now coming into this year, the blue line's coming back up and it's starting to flirt with that 50. So we're seeing kind of what we projected to see coming, like they would actually come out of a recession frame. And we just haven't seen that recession yet, which does concern. We're looking now and say, is that something we're 6 or 12 months out? It's not like it's not coming. It's just a matter of it really just hasn't materialized. Okay. Just market cycles in general, it's going to happen. That's a matter of the crystal ball, right? Now, the service, what it shows you there is, it dropped below 50 for, a bip, and then, kind of been bouncing around between 50 and 55. But obviously you can see the market slow down because it came off of a high of almost 68. Okay, so it definitely had a slowing process, but both of these are indicating that we're still kind of, heading more toward growth than we are toward slowdown. Consumer confidence and sentiment is actually a pretty good number. And we have labor participation. That's the one thing I forgot to mention. It's actually up to like 62.7%. And it's, slowly ticking upward. And then we want to see that because more labor participation is hopefully less pressure on wages, future wise. So with that, flipping to the next, I'm skimming, you guys don't have to. Domestic equity wise, that kind of wraps it up from what we've seen market wise. The one thing I would point out is if you look at page 1.4 in the bottom right corner, that's the PE ratios on where we're at. The dotted lines are the 5-year averages. So the yellow is the large cap or your S&P 500 stocks, and the dotted blue line is the small cap, your Russell 2000. And you can see that in both those areas they're pretty much right around their 5-year average. So we look at P ratios, is there still room? There's still room for investment in climb, and that's really why if you watch, the first quarter was really strong. April was very choppy, and May so far has been going fairly well. So we might be going into that classic, May is the month of sell and go away from the vacation kind of concept, and we may see a little bit at the end of the month, going into Memorial Day. But with that, the one thing I want to talk a little bit more about too is actually on slide 1.6. So the inverted yield curve basically is that On the short end, you can actually get a higher return or a higher interest rate on your short end bonds compared to your long. And typically you want your curve to be the other way, all right? So the reason I bring it up more than anything else is inverted yield curves are usually an indicator of recession coming, okay? We've had an inverted yield curve now for almost 2 years. So it's just another one of those things from your typical economics type of standpoint, the economist, it's driving them a little nuts. It's driving our analysts nuts. It's something we're watching very closely because, as I said, everything was mixed for some type of recession, and it didn't quite happen, at least when we all expected, which I believe a year ago, most analysts would have told you, okay, with the way 2022 went, we were gonna see it come sometime in 23. So, and now we're all looking and saying that probably it's not gonna come in 2024 either. So we're looking at something that may come, after the election. So, and there's the joy of being the president, because whoever's in office will get blamed for it regardless. So I always, it's like being the head coach, basically you get too much credit when you win and too much blame when you lose, and it's basically going to be that kind of play out. Although with the way the numbers are going, we could see kind of this sustained pattern of, the economic numbers are just good enough that we don't drop down and go a ways longer. But with that, we can flip into, but before we flip, let me get to one last page here in section 1. I like to call it our radar. We kind of give you a feel, it's on page 1.8. This gives you a feel quarter by quarter how we're looking at what's going on in the markets and how we're looking at how we'll allocate if we'll have any type of major overweights or underweights in any of the major areas. So you can see with domestic equity, we kind of pulled back from being more positive to what we were seeing through the first quarter. And we pulled back to more of a neutral stage. And it is just because it's a bit of a wait and see. And once again, we're in an election year, so that's another issue. For the Fed, they would like to stay out of this. So I think that's another reason why if they don't see the data they want to see, they will try to stay away from making rate adjustments at all. But the other key message the Fed was also indicating was like, look, we don't want to start taking this down and have to turn around and raise it back up. So if we don't get inflation kind of really where the direction that below that 3 heading toward 2, we're not going to make any significant changes, especially if we're having the type of economic numbers we're having, where there's not a lot of pressure from that. But with that, so we're somewhat neutral there, and really international equity, similar story, more due to what's going on so much geopolitically kind of concerns us more, but because we feel there's actually, it's almost like internationally, they're a little more pent up and ready to grow because they've been stagnant as far as their GDP, from the Euro standpoint was just 0.1. So it's definitely stagnant there, and we think they're kind of up and ready, but let's face it, there's a lot going on there. So with that, page 1.9, and that's where we talk about where monetary risk, we feel somewhat neutral right now. We feel like the Fed is just going to take their time and it's going to be a slow process. Economics, we're basically more on the positive side of things from the standpoint of the growth is there, the numbers are there. Inflation, we feel is, we're neutral on it, but only because it didn't quite go down again, like it ticked back up about 0.2%. But with that, we still feel like the Fed's kind of holding, and I think that their plan is to hold here so that they don't have to raise, and again, they can hold until they get to a point. But the biggest thing is the bottom right corner. That red, if we could make that red more red, we would. It just geopolitically wise, what we have going on in the Middle East and then the Ukraine war, and China is just sitting over here licking their chops at Taiwan. So there's a lot of issues that feel like they could go, the wrong way. And when you look at China looking at Taiwan, the way I describe it is if you think of corporations, large corporations, when their growth gets stunted, what do they do a lot of times to make growth? They acquire, right? So, in China's nice little government way, they're looking at a different way of acquiring, but that's what really, they're looking at Taiwan going, that's a cash cow. It makes the whole world nervous because Taiwan's making most of the chips. So
That would truly be a hostile takeover.
Yes, yeah, it would be. It would be a whole other level. But I mean, when you think about it from an economic standpoint, that's part of the issue. It's less about them spreading their government beliefs and more about we'd like that money and we just like to take it, basically. So there's a lot of pressure there. So those are the type of concerns that when we look at the economics and we say things are going in the right direction, and they're really sustaining, those are the things that make you nervous because it can really cause a stop. So from that end, we can jump into the portfolios. What I'll do is let's skip to tab 3. Tab two, what we do typically in tab two is just what we call it the executive summary. I put all 4 plans there. But I think for this time, since this is the first time in the room, we'll go through tab 3, which is the police plan. I'll kind of walk through the whole portfolio, and then we can flip back up and look at tab 2 and see, the rest of the plans from that end. So as we go into tab 3, 3.1, the police plan has, as of March 31st, $76,549,933. I'm going to round off from there for now. I'm not keep going through the numbers like that, but with that, the quarter was a good, strong quarter. We had a return of 4.86 versus the benchmark at 4.62. Sliding over the short end of 1 year and the 3-year numbers are slightly, the 1 year numbers 13.75 versus 14.42. And then the 3-year numbers are slightly behind at 3.74 versus 3.82. 2022 was a tough year, and we actually got pretty defensive in that year, and we stayed in that defensive position going through 2023. So between our defensive position in 2023 and then the Magnificent Seven, from a market standpoint, if you haven't heard that enough, but 7 companies really did drive the market for the most part in the domestic equity area in the US. So with that, some of our active managers weren't necessarily, heavily weighted in those 7 companies. And we index a good portion of your portfolio to keep costs down. And also because it's hard to find active managers to consistently outperform in the domestic equity world. So why pay extra for managers that can struggle sometimes where you can get you can get a passive approach and do pretty well. So with that, a little bit of a struggle on the shorter numbers, but as you see, as you go out further, and these are the numbers that truly matter, the long numbers, your 5-year numbers at 7.93 versus the benchmark at 7.7, 7-year at 7.83 versus 7.55. We do 2 types of inception numbers. Inception number on the far right is going back to 2003. 7.36 versus the benchmark at 7. 7 is a key number here. That's really where your plan needs to stay above to meet, when the actuarial does their reports and their features. 7 is your hurdle rate, as we like to refer to it as. If you stay at 7%, you meet your future obligations. You keep your funding status at a good level, and you guys are at a good funding status level. Compared to most of my clients, like a lot of other municipalities we find are struggling. You guys are at a good funding status right now. So with that, and then the column to the left of that is when we switch to our discretionary asset management process. And so you can see there 7.59 versus 7.48. So that's the overall plan. In an effort not to bore the heck out of you, I wasn't going to go through every individual manager through here. But the top box is your domestic equity. The bottom box are the international managers that make up your portfolio. But they give you a little bit of a view. So domestic equity, let's take that, the top section. I was talking about a passive approach. 76% of your domestic equity is in a passive Vanguard total stock market ETF. So it's a few bips for the actual expense ratio on that. And as I said, it captures the market without really a major expense cost factor. And then we do have 3 active managers inside the portfolio currently. Jacobs Levy is a small cap manager, and then the other 2 are active, what we would call all cap, because they're not just focused on large cap companies, they're focused on all 3 areas, your large, your mid, and your small. And that's Aristotle and Von Nielsen. So that makes up your domestic allocation. And then international, similar as far as a little less though on the passive. Your passive approach is about 39% of your international equity, and then the rest is made up of the active managers. And why is that? Because we do believe you can find more active managers in the international space to still outperform the plan. Domestic equity markets are so efficient that it really is, it's a tight rope to walk to find managers that will consistently outperform.
Ask a question.
Sure.
So of your total equity, 34% is international.
No.
Yes.
23.
You have 31,340 and you have 16,287. So if I'm just looking at the equity, that's 47,6. You've got 16,2.
Slide to page 3.8. Okay, so here's your boxes. So the dark blue is the actual allocation in that bottom box. okay, of the portfolio currently. And the light blue bar is your target of your investment policy. So you see your international equity is 21% as the target allocation, and the actual allocation is at 21.3.
Right. But I'm just saying, if you just take your equity, a third of your equity is in international, which is pretty high when you look at what most people do these days.
Well,
I'm ignoring fixed income and
and you're just looking at the 65% of equity?
Yes.
And saying about
a
30.
third of that is international.
Is international. Yeah.
That's really high.
It is slightly high. It is something that our investment committee has been on a long-term, debating and looking at.
Especially you look at your 10-year numbers, your international is lagged dramatically.
Right, right. And that's one of the reasons, that's what our investment committee is like, targeting and discussing on a regular basis. We did pull you back a couple of years. It was actually a target of 23, so we pulled you back a couple percent, ways back on that target end. But, so with that, so how we're allocated right now today is how this chart winds out. So with that, we are slightly overweighted domestic equity. That's been some of the growth through the first quarter. So it's almost 41%. And then your fixed income is pretty much on target. About 4 years ago, we were probably on 5 to 6% underweighted in fixed income, and there was much more in the equity area as far as how we weighted that. But we have caught that up over the last 2 years, knowing where fixed income should go with the numbers from that end. And the fourth quarter, and actually 2023 overall, fixed income did well. It took a good half of the year, but the last half of the year went fairly well.
Rising interest rates aren't good.
Yeah, I have a question for you on the fixed income. So do all you guys use is ETFs? I mean, do you have any active traders?
Oh, in the fixed income, it's almost all active managers.
Okay, but you actively trade treasuries or individual bonds?
We select the managers to do the actual trading of
I mean, so, but the opportunity of buying
yes.
treasuries under par for a good yield the last 2 years on the inverted yield curve, you guys didn't take advantage of that at all.
From you mean individual managers? They're more set up in a core approach.
But you have nobody internally. You're shopping the managers externally.
Correct.
Okay.
And so some of those managers internally may have taken some advantage of shorter treasuries. But in general, the overall fixed income portfolio is targeted for a core approach.
Well, I get the core. I'm saying you could have taken advantage of that by buying individual treasuries, but you're saying you guys don't do that.
No, okay. We hire the managers, like I said, some of the managers internally may have done some of that. I can't dig that deep. So that's it. So, and then in your plan, we have over the last 5 years started to add some alternatives. So there's a slight allocation to private equity. Private debt and private real estate were two areas that we added a little prior to that. So private equity was the last piece that we've added. And that was probably just about a year and a half ago, like it was right at the end of 2022. It's the alternatives are good in the way that they can add some diversity. They can also, we try to find ones that we feel are not going to follow the market as much. So there's not as the correlation's a little bit less. But the downside to getting too heavy in alts is that you're invested in like a contract for like a 7-year time frame. They're not like, so you really can't, you can get your money back out, but typically getting your money back out, you're going to take it at a loss. So you're not going to see us get real heavy into them, but we are trying to utilize a little diversification and put them in there from that standpoint. The other thing they do, which drives me a little bit nuts, but they're a quarter behind on reporting. So when you're looking at the quarter to date returns, and if you look down and you find it on that previous page, we have to put it at 0 because we don't have a quarter to date number. So it's a little bit annoying from that standpoint, but with that, it does add diversification. We believe that it's worth it. The previous investment committee, we had worked a lot and discussed that over the last 5-6 years. So we started to add those allocations. That is basically, kind of the walkthrough I have for you. Are there any other questions or anything else?
So, not the world that I worked in,
Okay.
it was fascinating. And I was looking at the asset allocation across the 4 portfolios.
Right.
I noticed 3 of them were identical and 1 was not.
Yes.
How come?
Because the OPEB is different from the actuarial point of view and the way you just funded that recently over the last few years. So it's a different future layout, of future obligations, what you need to hit. The other 3 plans, when you look at where the funding status was and anticipation of where it's going and that will report, it made sense to have the same allocations.
So for someone who doesn't do this stuff for a living, does that mean you're basing the allocation upon the needs of the funds in the future?
Yes,
So these are phased this way because this is when you need them. These are phased that way because that's, need them further down the road.
yes, yeah, that's the way I would more or less describe
You know,
it. It's more about, for the pensions, so think about it this way, so as you look at, your employee now, how long they work, when they retire, how long they're expected to live and collect that pension. So you're lining all that up from your actuary, they do the reporting. They give, basically, so that we can see that hurdle rate, and then we look at the markets and try to design an allocation to meet that number and measure the risk to get there.
that's why the three are the same and the one's different.
So with that, if one thing, flipping to tab 2, that is the executive summary, we just walked through the performance for all 4 plans. So the first 3 plans, are the police, the employee, the fire, and they're allocated the same. That's why you're looking at performances pretty much, very similar, off a few basis points, mainly because of trading that we go on throughout the process. The OPEB plans, the ones allocated a little bit different, and also the smaller amount of assets, there's no alternatives in there. So you're getting the full report there. There's no manager being reported as 0 for the quarter. So you're getting like the full performance for the OPEB when you look at that performance. So as it catches up, these other 3 plans had performance basically between 4.86 and 5.29 for the quarter roughly in that arena. We just don't have those numbers yet for that quarter. So we can't, that 5 to 6% that's in alts right now are reporting as 0. And it takes a little time for that to catch up. Okay, but that's what you're looking at.
Barry?
Yeah, so the 7% sort of benchmark that you guys are, the hurdle to meet, is that something that's been historically stagnant, right? Or is that something, because we're at 7.36%, that beats the 7%, right?
Right.
So do you see the 7% number needing going up in the future to, 8, 9, or?
I would say no.
Went down.
It went down.
So it costs us more the lower the discount rate goes, all right? The higher the discount rate goes, the less it's gonna cost us to pay into the plan, meaning from general fund tax dollars. That in 10 years ago when I started, was at 7.5%. It's been lowered, 0.5% in my 10 years. That is driven mostly by discussions between myself and the actuary. And where funding is needed, and what we're seeing within the plans. That as we lower that discount rate, if we do, funding then has to go up from somewhere, right, which is general fund tax dollars. It can also come from employee contributions and other, investments and all those things, but generally the makeup is the general fund side of things. To give you perspective of where we're at with a 7% discount rate, both our employee and fire plans are well over 105% funded. And our police plan is 96% funded. And I saw the eyebrows raised. That is very rare to hear that. This has been a collective effort over 20+ years. As Terry has been here for the majority of that time, these plans are very well funded. They are acknowledged and taken care of at an actuarial level, a pension investment level, and a staff level, and quite frankly, a commission level. The commission gets reports from me regularly. We report on it and at certain times even allocate additional funding if needed to make sure that we're ahead of the game and we're not. 2015 or 16, we saw some storm clouds ahead. So we reserved aside some money to make sure there was never a question that we weren't going to fund what was actuarially determined to make sure our payments are all made on time. We actually have made some adjustments where we actually funded earlier than most municipalities. Our police plan, we fund $1 million in January, we fund $1 million in April, and the remaining in August, September timeframe. generally, prior to me getting here, in general municipalities, they wait for their state pension aid, which the state contributes towards pension plans. So they wait. Well, when you wait, it costs you more money actuarially. So we've made adjustments like that, and we're able to do that here in Mount Lebanon. And with the commission's blessing, we've done those types of things. So it's a team effort to get there. And we have all those reports and those types of things. As we progress in the financial management board, these things will start coming up. You'll get actuarial reports and, you know, those types of things as we move along. But they are in good hands, and the pension investment is one piece of that.
I got a question for you, Andrew. So again, not my world, but very similar in so much. So working in DoD, well-managed programs occasionally get rated by poorly managed programs.
Sure.
Is the money safe? Is there, is there a way that, something in Mount Lebanon that needs more money for something else says, hey, let's go raid these guys? Because you see private pension funds being sucked up by, investors. Do you have any sort of issue or risk here to that?
The short answer is no. There is no risk to the funds that are sitting there. The only thing that could be quote unquote manipulated, for lack of a better term, I'm not saying it can, is not funding what the actuary tells you need to fund on a yearly basis. So we're we're close, I think, what, 3 million cumulatively between the three plans. We're around $3 million, right? So if it was a hard year, the commission could decide, hey, we're not gonna fund it all the way up there. There are mitigations that you eventually have to make it up, and there's rules that go into that are governed by the state. We're never getting there. I think that's where the team concept comes in. I think the commission is very much online. I don't mean to speak for the commission, but
I'm saying that, this is year 11 or whatever for me. And the point is that it's just, of course, we're funding. There's not we get to, the discussions in November, December, say, well, maybe we'll pull from, no, it's just there. It's almost like in your paycheck, whatever comes off the top for your savings, it's just funded. There is no, maybe, it's just done. It's the money's put in there.
Nothing ever gets pulled back from.
That's that US Bank.
That was my question.
yeah.
Nothing will ever be pulled out of those accounts.
So we,
Not without handcuffs.
Yes.
so Terry, that's a good question. I mean, I think you see a lot of, we're different in the fact that it's a public plan. It's not, you're not a private company type of plan. That's number one. Number two, I think, it is looked at by so many different people. You will be receiving a 5-year pension audit that was conducted from 2018 through 2023. And Terry's laughing because it used to be done at a 2-year frequency, and we just had a 5-year one done. And they literally go through everything I did for 5 years, like every nook and cranny that, so they go through it with a fine tooth comb, every transaction that comes out of those plans. So they're outside of all our annual audit, they look at it as well. They do it in more of a testing like an auditor would, whereas the auditor general looks at every transaction that comes out of that plan.
I wasn't talking so much about malfeasance of an operator as, the city, the state, the county saying, well, we're running short. Those guys have money. Let's find a way to.
And I say that not only in malfeasance side, but also they would be calling it to question to where they would be issued a letter. And multiple people will be issued a letter saying, hey, this shouldn't be done. You can't do this, especially on the fiduciary side of things. So
And to go
it's never been brought up.
Right, and to go back to where is the, but risk in air quotes, the commission just goes, nah, we're not funding it. We want to put that money into something else. Again, the attitude of commission has been, as long as I've been on commission, has been, no, this gets funded. This is not a debate. This is not a discussion. It just gets funded.
That's great to hear.
Yeah, it's been, and when we get closer to budget time, I think this board will start to see the way we craft the zero-based budget, right? So there's things that come off the top. So pension funding's right at the top, debt is right at the top. Your police force, your proactive patrol, those types of things. Those are all at the top, and those haven't changed in 30+ years. And I don't think that's going to change, so.
Thank you, sir.
Any other questions? It- it-
Thank you, Perry.
To jump a little bit to commission report, because kind of on the subject in a way, it fits how the municipality looks at budgeting. We just, for instance, received the update from Andrew. Optimistic in the right places and pessimistic in the right places. The idea being is that when it comes to expected revenues in a year, it can't be this good. It's very pessimistic on what's coming in. And the same thing on what we think expenses are gonna be. Maybe optimistic's the wrong word to use, but like, it's gonna be higher than we think. Because if it goes the other way, you're really having trouble. And so that has been a philosophy that has been executed every year. I think it's a very good one. At the end, like for instance, again, the report that just came in where we wound up with more money in the coffers, if you will, than was expected because revenue was a little higher, expenses were a little lower. Okay, you just don't want to be the other way where, if you've under budgeted in the wrong direction, now you're trying to fill a hole in the budget. So, Andrew can certainly provide the exacts, but the gist is that, there is funding left over. Now it's up to commission to say, what do we do? There is something commission has talked about that with the police department of a social services coordinator position. The idea being is a certain amount of what our police department has to deal with is are mental health situations. And these mental health situations are things that and they talk about a soft handoff. They get to somebody and the reason why they're in the situation they're in, they couldn't afford their medicines or they weren't taking the medicines or they're hoarders or whatever. And the idea is to get that person to some sort of care, someone's got that expertise. And there's a committee up in the northern suburbs that does it very well. And that's a model we're looking to explore. We do that, obviously that's money for a salary in that situation. So my point is, we finish the year, we get the report from finance, and commission starts looking and saying, all right, what sort of things have we looked at, funding issues and so forth. Commission continues to talk about more sidewalks. We hear a lot from residents about extending our sidewalk network. So we evaluate these things. And certainly I've said it year after year, every budget I said, there are many worthy projects that do not get funded. We're gonna get to the end of this and go, there's gonna be some worthy project that doesn't get funded. We have a very deliberative process we go through and say, here's what's available, what do we want to do? And there are years and times where we go, keep that in the nest egg. There's actually a very specific process where the goalposts are 12 to 15% of unassigned funds that's the rainy day fund. To my mind, if we go a little higher than the 15%, okay, because stuff happens. When I was president in 2018, we actually had to tap the rainy day fund because of rainy days. We were having so many stormwater issues that we had to spend a lot of money to address those sorts of stormwater infrastructure projects. It wasn't planned, it needed to be addressed. We pulled the money out, we spent it on that. So I was just trying to give the group some background of kind of what's in the mind of commission, how we operate, how our finance team operates. So it's probably not the usual commissioner liaison report, but I thought it's important that the group gets that backstory.
So the 12 to 15% that he's mentioning, you will hear that often in this. The 12 to 15% is of the prior year expenditures. That's a nationally recognized benchmark from GFOA, which is the Government Finance Officers Association. So there's a recognized benchmark that you benchmark your either expenditures or revenues against for your unassigned fund balance, which means your things are not dedicated to anything. So you may hear that as we move forward, but that is a nationally recognized standard that when we go out for bonds, bond rating companies absolutely analyze every fluctuations as we go, where we've been, those types of things. So that's what he was referring to there.
Yeah, and actually you're funding your pension plan helps your bond ratings. Your funding
Significantly.
status, how you fund it. That the funding early like that it's brilliant. It's Andrew's idea of coming up with working with the actual.
Brilliant.
It makes a big difference.
It has to be-
It's things on paper that I was like, can we avoid that? Let's do it.
Yeah.
It just makes a difference.
It's hard to believe that timing, but we're saving money overall.
Yeah.
Great. Let's do.
I'll even give you an example. Think how well 2023 went. Most of my other clients dumped their money in October.
Yeah.
November.
That's what we used to do.
Yeah, so he missed out on that return, the whole.
Plus the dollar cost averaging by
Right.
putting it over the course of the
And
year.
plus the actuary actually, when they run their numbers, am I saying it correctly? They basically look as if the money that you're contributing in October, November was actually in there January 1.
That's a Kim's loss.
Yeah, I mean, so so that's where you're eliminating a lot of that, and you are doing a little dollar cost averaging. But
A little bit of disclosure, some of the group was here earlier. Perry, I've known Perry that he used to work for PNC for their pension investments. And he did the work for our company, so we won't say how many years ago that was.
well, neither one of us had gray hair.
So we did skip number 1 on our agenda, so you'll have to forgive me as the first time coming into this board, I got a little excited.
Excuse me, interruption. Do we want to let our guests?
He can leave anytime he'd like.
Okay.
Thank you, Perry.
But I wouldn't want to spend another hour.
Safe travels.
Yes.
Um,
We'll see you. Take care.
yeah, see you, Perry. So we need, do we have a motion to approve them, or did everyone have a chance to review them?
Yes,
They were so
very voluminous.
very relaxed.
Yes.
I move to approve.
Second, got it. Okay, all those in favor?
Aye.
All those opposed? Great. Staff liaison report. The only thing I'll report is about minutes when the pension, plans are presented. They're very limited. There's not gonna be verbatim or even close to what he said. It's in the report, it's public. If anybody are ever to request it, they most certainly can have the report and read the PFM report. As you can notice, there's probably a disclosure on every page of that report. So just to know that that's gonna be, there'll be a very pared down version that we've done for years that we'll make sure it's there. So moving on to item 7, so we need to elect officers. So we need a chairperson and a vice chair for the board. They are asking me that we get one. So do I have anybody that would like to volunteer for said position or positions?
Well, I'm ineligible, so I.
If no one will do it, I'll do it.
Very good.
There you go, 2 volunteers. Who just wants to be the
You're
Chair,
younger,
the
you can be the
assistant chair.
chair, and I'll be the assistant.
I just heard the gray hair thing. That was-
Yes.
I'm gonna avoid that.
All right, so somebody want to make a motion for Jason?
We need-
I can't really make.
Oh, we can't make the motion. Someone has to make the motion to vote for Jason as chair.
Second.
All those in favor?
Aye.
Now that you are chairperson, you can now, right? Call
The
for a
whole
motion
thing for
for.
now, the motion for.
Sure, I guess we need a motion for our vice chairman.
Motion.
All right,
Okay,
I guess we'll have a vote. All in favor? Aye. Awesome. Great.
Congratulations.
Carries.
Yeah.
so, our next meeting, will be, June 12th, here in this meeting. I know we're getting into summertime, so, just be, I'll send the invite the way I did last time. Sometimes there are summer meetings where quorums are very difficult, so earlier, just let us know and we can just go from there, so.
Zoom is a quorum, right?
Zoom as an active participant, yes, it is a quorum, yes.
Camera on.
Camera on, yes, as Ian had told us last meeting.
Yes, camera on. You can't be like driving and have the camera on to the ceiling. No.
Nobody ever does that.
You gotta, well, that was why specifically in the rules. to say, have to be engaged.
The only thing I would tell you is that, so now that we have Jason as our chairperson, so the direction that we've been given as staff is that, communications with Jason for topics at this meeting need to kind of flow through him with a copy to us. His email's out there, on the SharePoint site. If you need it, just either reach out to me or it should be on there for you.
It's my first name, last name at yahoo.com, jasonruggles@yahoo.com.
And then he and I and Terry, we will set the meeting agenda, based on those things, and he'll work with us to set that agenda. So then we'll start bringing these, so it's not just staff talking to you, it's things that you would like to bring before the board, to discuss from there, so. So we'll
Jason, I
start
think
with
you might have
you.
my email address as well, if you have any questions.
Thank you. I will, thank you so much. I appreciate it.
I have nothing else for this evening.
I moved to adjourn. I was reading to see if there's anything else. Did I hear a motion to adjourn? Right, so we'll take a vote, all in favor? All in favor? Any opposed? Everyone carries 56.
To try and feed you the subtitles and stuff.
No, I used to, I guess this is a long time ago in college, I used to run meetings. I have memories, but some of them are quite fuzzy. So.
Many memories from college are fuzzy.
Yeah. The edges are nice and soft. Everything is perfect. Grades are great.
So when you send large PDFs, we're gonna get a paper copy in the meeting as well?
Yes.
Okay,
Okay,
Yep.
that's good to know.
see me from pretty.
Only
Yeah.
kill the tree